All right. I should have let you know, Bronson. Jordan is doing nothing. He is not getting up here. I am all alone. Okay, I shouldn't say nothing. He's recording back there. No. Well, it's a pleasure to be here. I thought I'd start out a little different today because I had a thought, and maybe this will totally bomb, and I won't do it again. But I was like, I give this presentation a lot, and I was just thinking, like, why do I even have the job that I have? Why do I even have the company that I founded? This $3 billion in assets. We help people use retirement accounts to invest in real estate in a private company, basically not on Wall Street. And I was just thinking, like, we exist. The whole reason I have a job, I should not have this job. My company should not exist. Except traditional financial services wants you to invest in what they sell. Okay, that is the only reason I have a job and my company exists and provides any value whatsoever, is because traditional financial services, where most people have their retirement account, there's $45 trillion, wants you to buy what they sell. You got an account at TD Ameritrade? What are you going to buy? Stocks, bonds, and mutual funds. Why? That's what they sell. You got an IRA at Northwestern Mutual or New York Life? What can you invest in? Annuities. Why? That's what they sell, right? You're buying that just because that's what they sell. Why don't you instead go to a place where you can buy something because it's the best investment? Right? Isn't that what we're trying to do? So that's why my company exists. I'm going to try to give context for that. If you're like, what the hell is this guy talking about? I didn't mean to get all philosophical necessarily, but I want to unpack this topic, okay? We truly believe that you should invest in what you believe in and what you know. And the reality is most Americans have a big pot of their investable dollars, particularly long-term dollars, where they're okay locking it up for a period of time, 10, 20 years, right? But they have it in IRAs and 401ks, and most people have no idea what they can do with it. They just think they can only buy what is being sold to them with their retirement account. Okay, so I am an attorney, so I'm going to give you a disclaimer here. This is educational in nature, yada, yada, okay? All right, so a lot of times, we're talking about real estate here a lot, and that's the business that Sunrise is in. And I think a lot of people are like, why is a retirement account guy here? What's he doing here? Well, I'm here because of this. There is $48 trillion in U.S. retirement accounts. There is more money here than any other place to invest in anything, all right? It's where Americans have been told to put their money. We got tax incentives to go there. When we make money on our retirement account, we don't pay tax. It's building up, tax deferred if it's traditional, tax free if it's Roth. So we've gotten all these incentives. And in fact, the biggest segment of retirement accounts is IRAs. And with an IRA, you can do whatever you want. You can invest in what you want. You can move it to whatever custodian or company you want. A lot of people think 401ks are the big player in the market. Not anymore. Most of the money now is sitting in IRAs because people rolled money out of employer plans like 401ks. So how many of you have an IRA here? See? That's what I was talking about, okay? And you probably got some money in it, okay? Let's just as an example, let's say I'm gonna do the calculator here, so I don't jack this up. Okay, let's say there's 100 people here. The average American, and you guys are above average, but the average American has 160 grand in a retirement account, okay? That means there's $16 million here in IRA accounts. Okay, if we were average, all right, let's say you guys are 3 times the average, that'd be $50 million. Okay, so, and I think, most of you guys are all accredited investors. I think you're at least that. That's a lot of money. And do you know all the options on how you can invest it? And this compounding we've talked about over time, I mean, getting 1 or 2% better yield than this crappy ETF or mutual fund you don't even know what it's really invested in can be massive to you in your long-term wealth building. So I want to make sure you know all the tools and strategies and things that you can do. All right, now I'm going to be talking about alternative assets, if that's a word, like real estate's this alternative asset. It seems to be one of the investments that's been around, since Earth was created. So, but it gets in this alternative category. What I'm not talking about here is stocks, mutual funds, and ETFs. What's happened, though, is the wealthy people have shifted away from the public markets. They're not investing primarily in the stock market anymore. They've said, we're going to go invest in these alternative assets. Why? Because they produce greater yields. And there's tons of numbers on this, and we see it in our business. I see it in investors every day. I've been a business and tax lawyer for 20 plus years, talking to clients that are making money, that own businesses, or have a tax problem. And what's the thing that they're doing? They're buying more and more, quote unquote, alternative assets. Real estate being a huge part of this. But this could be small businesses, this could be private debt, this could be private equity. There's lots of categories in this. Real estate in its varieties is probably the most popular one we see. So there's this huge trajectory of growth and money going into it. We're talking trillions of dollars and increases of how much money is getting allocated to this asset class. Do you know that the actual amount of publicly traded companies is 50% of what it used to be 20 years ago? There are less publicly traded companies you can invest in today than you could 20 years ago. Isn't that crazy? And so everybody's just fighting over these same publicly traded companies. But what's happened? Well, people don't want to go public anymore. They don't want to take their business and be publicly traded. They're staying private. They're going private. This is creating investment opportunity for people and investors to go find where are these private assets where I can get a greater yield than fighting over all the scraps in the publicly traded market. So JP Morgan, right? This is the most Wall Street of Wall Street places, did a report where they said, hey, rather than telling our clients to buy 60% of their portfolio of stocks and 40% in bonds or fixed income, was like traditional financial advisor, advice. They said, what if we did 30% in alternatives, 40% in stocks, and 30% in fixed income? And they did that for a while. Well, their result was they said our clients made more money and they had less volatility in their portfolio. All right. This is them admitting and saying, we're going this way. We're not just deploying into the publicly traded market. This is a really interesting stat. Okay, so this is people who are mass affluent. Okay, this is around 1 million. This is people who have over 1 million, over 5 million, and over 10 million. This is the percent of that they allocate to alternative assets. All right, so someone with a 10 million greater net worth, they only have 19% in the stock market. Isn't that crazy? This is an Ernst & Young report. This is from 2021. I keep trying to find the updated one. But high net worth people are going more and more to alternative assets. Maybe they're smarter or they know something. Maybe their investments are growing and performing better and they're over in that category. Whatever it is, these are the stats on where that money's going. And if you think kind of, I want to say kind of like, and we've all kind of been in different phases of the economic ladder. I certainly have. From being like a broke teen dad, like I've been like, don't take this negatively. I say it's like, someone who's working and they're not focused on their investing and they're in a different phase. They're trying to get out of debt. They're trying to support themselves or their family, whatever it may be. If they're saving and investing, it's just going in the stock market, right? Because it's easy. And that's frankly sometimes the only access that they have. But as you start getting into other opportunities, maybe you're accredited, you have other things to invest in, well, this is just where the wealthy people are going, and it's because of yield. All right, now I want to talk about your retirement account. All right, so if you believe in alternative assets, I'm not trying to convince you necessarily, but if you believe in alternative assets, and there's tons of different categories of it, and even within the categories, there's different places you can invest, of course. But what about doing it with my retirement account? Like I speak to real estate professionals all the time. I'll be like a realtors conference or whatever, and I'll ask, how many of you have a retirement account? Like half the room raises their hand. I'm like, how many of you invested in real estate? There's like 2 or 3 people, and there's hundreds of people. And I'm like, how many of you can tell me a good mutual fund? And I'm like, or an ETF? Nobody. How many of you don't know a good real estate investment or a good property to buy that you can make some money on? Everybody's like, oh, yeah. I'm like, why are you guys not investing in that with your retirement account? Like, are you just lazy? Like, what's happening here? Do you not care about, because from my perspective, I want my assets, money in my retirement account or other, things that I've made money, I've set it aside. I want my assets working for me so my ass doesn't have to work for me, right? And so it's like, we're just lazy. Like, get focused over here and get it going, all right? That means you can do less over here or more of what you want, all right? Swearing? Okay, I'm sorry. That was like, I don't know your audience. That's as bad as I get. Okay, so we want our assets working for us, but what about our retirement account, that $45 trillion? Well, the greatest investor using a retirement account in a self-directed format is this guy, Peter Thiel. Peter Thiel is part of the PayPal mafia. If you guys aren't familiar with them, he's one of the co-founders of PayPal with Elon Musk, and a bunch of other people have been wildly successful. But one of the other things he was known for is he was the first outside investor in Facebook. So if you've seen the movie The Social Network that's about Facebook, apparently most of it's not true, according to Mark Zuckerberg, but there's a couple of scenes in there that are like, oh, this was actually what happened. There's one scene in that movie where they go to get their first investor, and it's their very first outside investor they're taking in capital from. And they're getting $500,000. And before this, it was Mark Zuckerberg had the partner Eduardo Savron, whose family was like funding it. And eventually the family was like, we're not giving you any more money for your stupid computer business, right? They didn't understand it, right? It was this like early internet social media stuff. It was thefacebook.com back then. It was only on college campuses. It was invite only. It was like, nobody had heard of it really. And so they were like, we got to actually convince a real investor to put money in. Like, we've got to, and they were like 20 years old, right? The college dropouts, okay? So they got recommended to this guy, Peter Thiel, tech investor. He'd made money in PayPal, very attuned to technology. And Peter Thiel said, I'll invest $500K. I think he got around 10%, I'm not sure. Somewhere around between 10 and 20. But he was their very first outside investor. And you see it in the scene, in the movie, that he's like this tech investor investing in the company. So what he did, though, is he put in $500,000 from his Roth IRA. He didn't give him a $500,000 check personally. He gave him a $500,000 investment from his Roth IRA. He had a self-directed Roth IRA back at the time. I know the people he worked with. And what happened is that investment into Facebook, and Facebook turned out to be one of the most successful companies of our lifetime, is now worth over $5 billion. Okay? And that is all entirely tax-free. Okay? It's growing tax-free. When he sells that stock, it goes out tax-free. Just if he bought Facebook on the public stock exchange, okay? And you can do the same thing with real estate, right? That same principle of I invest in something, I pay no taxes, it's growing in my retirement account, and if it's a Roth, it's totally tax-free on the way out, all right? So this is an option available to us. What we know of retirement accounts works the same, whether it's publicly traded asset or a privately traded asset. Okay, now the first thing people usually ask is, well, Matt, I heard you speak. I called up Fidelity where I have an IRA, and they said I can't buy real estate with my IRA. You're full of shit, Matt. So I was debating whether to say that, because that's what they say to me. That's what I hear. They're not happy. And that's not because IRAs can't own real estate. That's because Fidelity IRAs can't own real estate, all right? Fidelity's internal policy says we don't want to deal with this. We want you to type in something and the technology to just place the order, and we don't want to deal with these private assets. It's paperwork. We don't want to do that. Why would we do that? We don't have to. We got people lining up to buy the stuff that we sell that we actually make money on. So the same thing if you're TD Ameritrade or your credit union. So what you need, though, is a provider of retirement accounts that says, hey, we're open architecture. We'll let you invest in any asset allowed by law. Real estate deal down the street, private fund, mobile home park, whatever. We'll let you invest in any asset allowed by law. And that's what we do at our company, Directed IRA. Now, there's probably 20 other companies that do what we do. We're not the only company out there doing it. We're just the best, okay? So it's the only one you need to know about. So we have some customers here. Thank you for your business, by the way. But so what you do is you say, hey, I've got 300 grand in a Fidelity IRA. It's a traditional IRA. It's a SEP IRA, a Roth IRA, doesn't matter. I want to put 100K into, let's say, Sunrise. Okay, what do? You open up let's say you have a traditional IRA at Fidelity. You open up a traditional IRA at Directed IRA. You have 300K there. We can move the whole thing, or you just move 100K. And then you say, hey, I want to invest in, let's say it's Sunrise. Okay, you fill out the subscription agreement. You don't own these shares, these units. Your IRA does. It's the owner. And then you say, all right, wire the money. And then you own it in your retirement account. Now the profits or the distributions going into your IRA. Later, if you sell the shares or there's distribution, all the funds are all building up in your IRA. It's not hitting your 1040 because you don't own it. It's building up in your IRA, all right? And you can still be in this market over here. You know, you could 100% self-direct, whatever. Most people do a piece of it, but it's totally up to you. So this is why we exist, to let you invest in whatever you know and believe in. So you have the ability to find the best returning investment to grow and build your retirement. Okay, I want to go over a few examples here. So I heard about this in 2006. I had a client. I was a young lawyer, and I had this client call me 2006 and said he wanted to buy real estate in his IRA. And I was like, I don't think you can do that. And then I got off the phone, and as I did as a young lawyer, I would look stuff up and be like, was that right? It's true. And we don't have ChatGPT or any of this stuff now, so I went to askjeeves.com, and I asked, okay? And the results came back, you actually can. And I was like, this is pretty cool. I was fascinated. I was like, I have never heard about this. Wasn't on the bar exam, hadn't heard anybody talk about it. I worked for a financial services company all through law school. I knew retirement accounts pretty well. And I was like, this is crazy. So then I asked my law firm partner, Mark. He's still my partner today in our law firm and some other things. And he's like, oh, yeah, I've heard of that. He's like, I've actually helped some people do that. You can totally do that. And I was like, oh. So I became laser focused on this. And I was just like, I'm going to specialize in this because this is totally cool. No one's talking about it. And it kind of put me down the path. But eventually I was like, I had to pay off my student loans. I'm like, I want to do this for myself. Okay, I was helping clients do this and make money. I'm like, I need to do this for myself. So this is the first deal I did. The first thing I did is I just bought a single family rental. Okay, you can do your own deal. Go buy a single family rental if you want or whatever you're into. This was 2017 in Indianapolis. I had a real estate broker client buying properties for himself in Indianapolis, and I'm like, buy one for me. Okay, so I bought this. It was $85,000. It did $950 in monthly rental income. I was cash flowing the property. I obviously had some expenses on it, and then I sold it for $184,000 about 5 or 6 years later. Now, all that rental income and cash flow was going into building up my retirement account. And then when I sold the property, the gain went all back into my retirement account, okay? So you can just buy your own deals if you want, right? Find a deal, find a property, I don't do that anymore, okay? Back then, I was a little more interested in doing that. I don't have time to do that. And it was a good deal. Don't get me wrong. It was a good deal, okay? So another option you can do, and I'm just going to give you examples of what I did, is I private lend my money sometimes, okay? So, like this is a property I loaned money on. I loaned 100 grand at 12% interest and 2 points. So my IRA had a promissory note and a deed of trust to the real estate investor, the lady who did this deal. This is in Providence, Rhode Island. I've got some contacts in the lending market in Providence, Rhode Island. Not illegal mafia stuff, okay? It's just, one of my big IRA clients, very large account, has awesome connections in Rhode Island. So I just do a lot of deals there for that reason. Anyways, so, but she's like this real estate investor / contractor / hairdresser, okay? It's like, the actor / waiter in Hollywood. This is not my type of person. She's my type of person, Owns a salon / contractor / real estate investor. She's out hustling. And, well, she couldn't get a bank to finance this. The property's in too big of disrepair. So she's like, I need private capital to go acquire this and rehab it. All right, cool. I'll lend you 100 grand, 12% interest and 2 points. So that's what I did on this property. Now, she's sold that. The other thing, she was smart. There's a lot next to this. There's extra land over here that she could split the property and add an additional lot that a lot of people didn't realize. So, but here, I'm not participating in the equity. You know what I mean? So there's not as much total upside, but I got a fixed rate of return, right? I got 12% and 2 points, which I was happy with. And I was secured on the property. I had a lien on the property, so she wasn't getting paid until I got paid. And then she sold, and I got paid back. And I've done a ton of loans like this. Now, I love some of this morning stuff because I geek out on all the investment stuff and compounding and all that about how you truly grow and build wealth. If you just think about this, and the rule of 72 was mentioned earlier too, it's just that's that $100,000 that I loaned on this. Let's say I put no more money in my retirement account. Just stick with this $100,000 just on this loan, and I keep reinvesting it under the same rate. Well, this is a 6-month loan, 12% interest, but I lend it out twice. Once the money's back, it's back out in 2 weeks, okay? So I typically lend that money twice within the year at 12% annual rate of return. But I get 2 points twice, okay? So that gets me 16% total rate of return, if you're following me, okay? Well, if you take the rule of 72, you divide that by 16, that means my money doubles every 4.5 years, okay? I'm 45. In 18 years here, what'll I be? 62? Is that right? 63, okay, 63. I was like, that didn't sound right. Okay, if I put no more money in, I just keep doing that, that 100,000 will be $1.6 million. That's pretty good, pretty good. So that's what I'm doing. I'm doing this lending, and I'm trying to find deals and opportunities where I can get a good rate of return. It's risk, the risk is reasonable. Obviously you can do crazy stuff. All right, next thing I'm also doing, investing in private funds. I'm not going out there to go do deals, guys. I got 150 employees between different companies. I got family and kids and other things I want to do. I'm not going to go out and put on a tool belt, work on properties. Bless you, all of you that do that. That's great. My partner, Mark, he loves to do Airbnbs. I think he's insane. I'm like, not doing that, okay? But I'll invest in private funds because I still love the asset class of real estate, all right? So I want to find the right deals and opportunities that other people have where they need capital. And how can my money grow with them doing the work? And we'll split some profits. I'm willing to give up some money for that. But I want to find the right opportunities. So your account could invest in a private fund, whether that's mobile homes, whether that's multifamily or retail or oil and gas, or it could be private equity buyout, it could be a venture capital fund, whatever type it is, whatever you have belief in and where you have the right operators, your IRA can invest with them, where you're getting a share of the profit, of course, based on the money you put in. Okay, now, that's what's possible. This is what you can't do, okay? So there are some things you do need to know that are important. The nice thing is there's actually less than you would think. Is there any attorneys or CPAs here? No? Okay, one person admitted it. Okay, I have all these citations for you to the tax code and revenue rulings and everything. My book, by the way, I have a book. If you open an account with us or you book a call or you're a customer, you can get a free copy of my book out there. It's got 100 citations in it for you. One person may appreciate it. All right, okay. So now here's what you cannot buy with an IRA. There's only 3 categories of things you cannot buy with an IRA or retirement account. Let's go backwards. The first is S corporation stock. We love S corporations, business and tax lawyer. I'm like, I have an S corporation. IRAs just don't qualify as an S corporation shareholder. Your IRA can own an LLC, a limited partnership, a C corp, that's all cool. IRAs just don't qualify as an S corporation shareholder. It's an S corporation rule, okay? Second, IRAs can't own life insurance, all right? Probably didn't come here wanting to do that, but you can't do it. And the third one is IRAs cannot own collectible items. This was something that was added into the retirement legislation later on once retirement accounts were already out there. And what happened is some people were buying like collectible items as investments in their IRAs because they weren't restricted. So for example, people were buying like classic cars, they were buying art, and this was owned as an asset in their retirement account. There was starting to be a lot of abuse of this stuff, right? They're driving the classic car on the weekend, you know, they buy a wine collection in their IRA and it ends up as a bottle collection, you know. And so Congress came back and was like, we're restricting collectibles. If the investment is deemed a collectible, you can't own it in your IRA. And they made some exceptions for precious metals, gold, silver, platinum, and palladium. But like you can buy those, but everything else, you can't buy it if it's a collectible. So real estate's fair game, all types of it. Now, when we're talking about buying real estate, I'm not talking about buying real estate you're personally going to use, okay? This is not a second home. I'm not talking about buying a rental property that your kid lives in college and their friends are there too, all right? We're talking about buying an investment asset where your intent when you're buying this investment asset is to get a good return, not to have personal use of it. And the reason that's important is the IRS, I should say Congress, made a rule about this, and they called it the prohibited transaction rules. Now, the prohibited transaction rules restricts not what you can buy, it's who your account can transact with. So for example, if my IRA is buying real estate, who am I buying it from? So like, let's say I'm buying a piece of real estate from my dad, okay? Well, my dad is a disqualified person and restricted. Okay, so if my IRA bought real estate from my dad, that causes this prohibited transaction. And if you have a prohibited transaction, you no longer have an IRA. Your account's distributed, it's subject to tax and penalty. We don't want to do that. So anyone in red here is going to be considered a disqualified person, okay? You're disqualified. So if you own a real estate deal now, or you own shares in a company, you can't just sell them over to your IRA, okay? That would cause a prohibited transaction. Okay, everyone here in red is going to be prohibited. You, your kids, your grandkids, your spouse, anyone from Utah here, all of your spouses, all disqualified persons. Are you really from Utah? Okay, I grew up in Utah, so don't be offended. I earned the right to that joke. Okay, all right. Okay. Okay. This is aggressive. I've got 9 minutes. Oh, I got 17 minutes. I got 17 minutes? Is that right? Oh, okay. All right. I just don't want to be between lunch. So that's the worst thing you want to be as a speaker is like people are hungry and you're still standing up here talking. Okay, 17 minutes, we got this. All right. How many of you heard that you make too much money, you can't have a Roth IRA? Have you heard that? Don't be shy. Have you heard that? Okay. All right. Okay. You heard that from some dummy, okay? And it's traditional financial services. If you Google it, can I have a Roth IRA if I make 200 grand a year and I'm single? Like if you put that in ChatGPT, it's going to tell you no, all right? And that's the surface level answer, all right? The reality is you can have an IRA. You just have to do something called a backdoor Roth IRA, all right? Right now you can put in, for 2025 still, you can put in 7 grand a year, in addition 1,000 if you're 50 plus, and you can do your 2026 contribution, which is $7,500 plus an additional 1,100 if you're 50 plus. So you can be putting in 15 grand or so into a Roth IRA like right now. If you didn't put any money in last year or you haven't done anything yet this year, you could be putting 15 grand. If you got a spouse, they could be dropping 15 grand into this. So between the two of you, you could be doing 30 grand in contributions into a Roth IRA right now. Now, if you're married, filing joint, you make more than 240 grand, you have to do the backdoor Roth IRA. What this is, all this is, it's very simple. You put money in a traditional IRA and you don't take the tax deduction on your 1040. Right after you put the money in the traditional IRA, you convert it to Roth, it sits in a Roth account, and voila, you have money in a Roth IRA. You can do this at Fidelity. You can do this at directed IRA. Most savvy accountants and financial advisors are familiar with this. This has been around for a while. They tried to close this loophole in the other BBB, not the Big Beautiful Bill, the Build Back Better, the Democrat one. Okay, not to be partisan, that one was going to be bad tax-wise. Okay, it was going to close this loophole out. That didn't pass. The loophole's still there. Okay, so you can still have a Roth IRA. I'm a Roth guy. We have more Roth accounts than any other account type in our company because our clients want to kind of do the short-term pain, long-term gain process of I'll not take a tax deduction to put money in my retirement account now because I want the tax-free growth over the long haul. Now you can self-direct traditional accounts too, totally fine, but we do love Roth. All right, this is a cool little graphic. And by the way, we can get you the deck, anyone here that may want this, if you want to reference some of these slides too. Okay, that's what I talked about. Okay, a couple other things. What if you have a traditional IRA and you want to convert it to Roth before you self-direct? That's a common thing. People come to us and they're like, Matt, I've got this old 401k of traditional dollars, or I got a traditional IRA at, TD Ameritrade, but I want to go just do some self-directing, open an account with you, but this pot of money, I want it to be Roth. I want that to grow and come out totally tax-free. How do I do that? Well, you can convert any traditional set of dollars to Roth. Let's say it's $100 grand. You have $100,000 and you want to convert it to Roth. The IRS is like, we'll let you change the rules. We'll let you move those traditional dollars that typically grow and are taxed on the way out. So let's say that I kept that 100 grand and it turned into $500,000 in the next 10 years or 15, whatever. And I'm now in retirement and I'm pulling it out. Well, I'm paying tax as I pull out that 500 grand, right? I'm not really going to receive 500 grand. I'm going to receive 300 maybe, okay? So what can I do with that 100 grand? Well, we can convert it now, and then let's let it grow and come out totally tax-free. Let's convert what they would call the seed. Let's not pay tax on the harvest later in retirement. So we want to convert it the smaller amount, hopefully grow it, and then have that come out tax-free later. So you can convert, but what's going to happen is you're going to get a 1099-R. This is a 1099 that will hit your tax return of taxable income. If I converted 100 grand, it's going to be $100,000 on that 1099. That's getting at my tax return. If I'm in a 30% federal and a 5% state, that's $35,000 going to taxes because I converted, all right? However, I got 100K rolling now tax-free, all right? If I can get that to $1 million, I'd rather pay 35 grand than 350,000 when I'm pulling this out later, okay? So how do I convert? A couple things. There's one method we have called chunking, okay? This was inspired by the movie Goonies, all right? There's a character in Goonies named Chunk, and it just works, okay? So what chunking is we say, rather than convert the whole thing and bump you into the highest tax bracket where you're at 37%, and if you're already at 37%, this isn't as viable of a thing. You can kind of delay the tax, but what chunking is let's convert amounts each year, or let's say what I had a lot of clients do just at the end of last year. So let's say you wanted to convert 200 grand. Let's just stick with my 100,000. I'd say instead of converting 100,000 in 2025, let's convert 50K in December, and let's convert the other 50K in January of 2026, so they're on different tax returns, okay? So it doesn't bump me up converting the whole thing over 1 year, all right? Because we have laddered tax brackets on your income. So chunking helps us minimize how much we're jumping into the next bracket on the conversion. All right, next strategy here is what we have a lot of our self-directed clients starting to do when they're converting to Roth, is they're doing Roth conversion discounting. Okay, what this is let's say that you make a $100,000 investment and this works in private funds. Let's say you invested 100 grand. When we convert that and it's invested in a private asset, the IRS will allow you to discount the value. It's not really worth 100 grand because private assets have something called lack of marketability or you can't immediately sell it like you can a stock. So they allow you to discount the value down as much as 30% so that you can say, I just bought this for 100K, but I'm going to convert it at really a 70,000 valuation, let's say. So I only get a 1099 for 70 grand. Right, so you'd be smart to not convert the cash. You could, but if you're going into a private asset, like a private fund specifically, you can do this discounting. Now, you can't do discounting like on that rental property I just bought myself because it's just me in the deal. But once you're in a private asset with other people where you're not in a control position, private fund is the most common, you can do what's called discounting. Now, you have to have an appraiser or a CPA provide the analysis to say why it works, and then we will convert it at a discounted value, okay? All right, I'm gonna take questions here in a minute. All right, solo 401k. This is a very ambitious presentation, guys. I hope is this making sense? Or is you guys like, Matt, you're boring. This tech stuff, okay. You can tell me outside if it sucked, all right. All right, solo 401ks. I like this stuff, I'm into it, okay? So, solo 401ks. If you are a self-employed person with no employees, this is your retirement account. Okay, it's not even close. This is your retirement account. I can't do a solo 401k because I have employees. But if you're someone self-employed or you got a side hustle even or some way you can justify a solo 401k, it's an awesome plan. What a solo 401k is Congress basically said, hey, because you have a business, this could be a sole proprietorship, an S Corp, an LLC, whatever, you have an actual business that you make money at, Congress is like, you can have a 401k plan for yourself. And you know what? You can put money in as an employee and you can put money in as the employer because you're self-employed. You're both. And it allows you to double up on contributions. If you think about a 401k somewhere where you've worked, right? You put money in as the employee, they deduct it on your paycheck, and then they drop money in as a match from the employer. But it's usually 3, 4, 5%, right? With a solo 401k, you can put in up to 25% as the employer. You can go as aggressive as 25%. So, but in a solo 401k, you can put up to $72,000 in annual contributions in per year. If your spouse is involved in the business and working there too, they can do 72 grand. All right, so the solo 401k is just a way to get a lot more tax-advantaged funds in every year. We have a lot of real estate agents that love this, physicians that or nurses that do like traveling type work where they're 1099, consultants. We have thousands of clients that love the solo K structure because they can drop a lot of money in every year. And you don't have to. It's not like you have to do the max amount every year, like some pension plans or other things. You can decide, oh, I had a great year this year, let's max it out. Oh, next year wasn't so good, let's maybe do half that. The other thing is you can do Roth dollars. So the solo 401k can have Roth dollars or traditional dollars. You can have a little bit of both. You can decide whether you want to do Roth or traditional dollars in a solo 401k. So now a solo 401k is a little different than an IRA. An IRA, you have to have a custodian, and they basically use IRS form documents to document the establishment of your IRA. Like that's what we do. That's what Charles Schwab would do. But in a solo 401k, you have to have an IRS-approved plan document. All right. So we have an IRS-approved plan document, and under our plan document, you can invest in any asset allowed by law. If you have a solo K at Charles Schwab, they have an IRS-approved plan document to invest in publicly traded assets. All right, so when you're doing a solo K, just make sure you understand what do you want to invest into. Okay, if you want to just do stocks, Schwab's cheaper, frankly. You can go there. If you're like, no, I want to invest in private assets or I want to do a real estate investment, that's where you would need a self-directed solo 401k. All right, so these are the components of it. There's an actual plan document, you know, the Vandalay Industries solo 401k plan, all right? Okay. See, somebody got that. Okay, I appreciate it. 2 people. All right. Vandalay Industries. You guys know Vandalay Industries? Okay. Okay. All right. Okay. All right. Art Vandalay. Okay. It's a Seinfeld bit. Okay. It's a whole thing. Okay. Vandalay Industries. Okay. Let's say you're the architect, Art Vandalay. You don't have any employees. Your 401k would be Vandalay Industries solo 401k plan. You have an EIN for it. You can have a bank account for it, right? Where you're able to write checks off of it even. You receive the income on the investment, so you can cut the checks out of it. We use a bank called Titan Bank that actually understands what it is. So those are the components of the solo 401k. Now, the way you get money in, I explained earlier, in a solo 401k, you put money in as an employee and you put money in as the employer. So let's say you made $100,000. Let's say you were an S corporation. We love S corporations for business owner clients. If you were like the real estate agent, the consultant, whatever, we would typically say be an S corp. So let's say you had a $100,000 W-2 out of your S corp. How much can I put in the solo K? Well, you can put in 25% of what you made as the company, which would be $25,000 off of the 100K. But you also get to put in $24,500 as the employee. So off of a $100,000 W-2, you paid yourself from your business in your S corp, you could put in, what is that? $49,500 in new contributions. All right. You took $200,000, you could max and hit the 72 limit here. But that's how the money goes in. It's a combo of employee and employer contributions to get it in. Not too complicated once you've done it once. It's the same thing every year. Okay, now you can self-direct your solo 401k. All the stuff I was talking about with IRAs, you can also do with a solo 401k. All these different assets are things you could actually invest in with a solo 401k. Some other things on a solo 401k. You can lend yourself money from a solo 401k. All right, you can take a loan up to 50 grand from your solo 401k and lend it to yourself. You can't lend yourself money from an IRA. Also, there's a new tax credit. When you establish a solo 401k, or if anybody even has one now, if you do something called an automatic participation agreement, where you say, I'll enroll all the people in the 401k automatically, which is just you, all eligible employees, the IRS gives you a $500 tax deduction every year over 3 years, which totals a $1,500 tax deduction. Okay. Plus, setting up the solo 401k is a business expense on top of it. In other words, the government's going to pay for you to have a solo 401k if you qualify for it. So that's a solo 401k. Again, if you're self-employed, you can do the solo K. Even if you have a side hustle where you're making money in a business and you have a 401k like a day job, you can still, your day job has a 401k you participate in and you get your match, you can also do a solo 401k on top of it. Okay, now I'm going to take your questions here. Hopefully you have some questions. I have 2 minutes and 48 seconds. Perfect. That is my book, The Self-Directed IRA Handbook. It's a great book, guys. Just saying. Who's read the book? Is there anybody who can give a testimonial on the book? Is it worth 20 bucks? Okay, Mark, thank you. Yep, the second edition, yeah. Yep, so, all right, I got an absolutely from Mark. That was a little risky, but I had confidence in the book, all right? By the way, the whole industry uses my book. It's honestly an honor. Like, every competitor in my business trains their employees off of my book. The National Association in the industry, the Retirement Industry Trust Association, has a certification program called the Self-Directed IRA Professional. The required textbook, and the only one, is my book. Okay, so it really is like the industry book. If there's anything I'm good at this, everything else I'm average at. Even as lead guitarist of Spilby Dog, I'm very average, okay? The only reason I even made the band was because I knew the people and I put it together, and I left a spot for me, So, okay, but if you book a call or you open an account, you get a free copy of the book. You can click on that. We have a promo with Sunrise where you can save 50 bucks on opening an account. Jordan is an amazing person. I was, giving crap about him because I was the only one coming on stage. Yeah, Jordan is incredible. He runs our marketing and affiliate programs and is here with me too. So he'll be here to answer any questions you might have. We can help. Our goal is really just to let you invest in what you want. That's pretty much it. We don't tell you what to invest in. We don't advise you to do this or don't do that. We don't make money when you invest on anything. We want you to find the best investment that's going to provide the greatest return, and we just want to be the mechanism in the account to help you get there. All right, questions? 53 seconds. Yes, Greg.
I don't look old enough, but this is my first year of RMD.
Oh, yeah. Really?
Yeah, and because of Sunrise
good
and some other investments, I'm in the very lowest federal income tax bracket. So is it going to behoove me to take any of my RMD requirements and roll it over into a Roth at 73 years old?
You are 73? Okay.
Yeah.
All right. Okay. Okay. Okay, all right. I'm not getting in the middle of this, okay? Staying out of it. Okay, great question. Okay, so if you have a tradition, just so everybody knows, just give some context here. If you have a traditional IRA or 401k, once you hit age 73, and this starts bumping up every couple of years, it might be 74 here, is you have to start pulling money out of your IRA. And it's kind of like about 4% when you hit it first. So let's say you had 100 grand in a traditional IRA. Well, what the government knows is on a traditional account, you pay taxes when you take money out. So they start forcing you at a certain age to pull money out because they're like, we want to tax this. So you hit 73, you have 100 grand, they're going to want you to take, let's say, 4 grand this year. And that'll hit your 1040 and be taxable income. All right. Now, if you have a Roth account, when you pull money out of the Roth, the IRS doesn't get anything. So they don't have an RMD rule for Roths. Okay? You can keep that invested and keep it rolling. It's great. So your question was, should I convert it to Roth? That was your question. You technically can't to satisfy the RMD. You have to take the distribution. So let's say it's 100 grand, you need to take the 4 grand, okay? Now there is a strategy though for a lot of people. If you don't have other income coming in right now, you've built assets, but you don't have income, you don't have a job or a business or anymore where you're having income, there's a strategy to just start doing Roth conversions now. So where you're basically chunking. You're doing that strategy, but maybe it's over 10 years where you're chunking it. So eventually you will have no RMD because the whole thing will have been converted, and maybe you chunk it enough where you're in like the 10% or 15% bracket where it's going to be very minimal because you'll get the long-term benefit later on. I remember I was talking to a client, high net worth client, had big traditional retirement accounts, a couple $1 million between him and his spouse, and he wanted to convert them all to Roth. Not because of the income planning now for him, because he wanted his kids to inherit Roth accounts. Okay? Like when they inherited those, he had 4 kids. Like he's like, I want them each to get like $500K of Roth dollars. I'll spend down my estate and pay the tax. He had an estate tax issue too, so it was like keeping his estate down. Think about this: if you inherit a $1 million traditional IRA, you really got a $650,000 IRA because you inherit that account, you're going to pay the taxes on it, and your kids are going to be in their highest income earning years, right? It's better if they inherit a Roth IRA. They got more 10 years to grow and build it. So anyways, I could give you all the Roth strategies. I love Roth. That was a great question. Sadly, it's the only one I have time for, but I will be here. I think I'm going to be facilitating a roundtable. I'll be participating in one, and this is flashing at me, time's up. Thank you, everybody. It was a pleasure to be here.